really interesting times, and I think that we're going through a relatively uncertain time at the present point, and for a number of reasons. And I say this in the context of real estate, which is, we're seeing a higher inflation environment. So inflation's really sticking at that 6% level. That's being responded to by the Reserve Bank with higher interest rates. And, we have seen a 400 basis point lift since May of last year to now 4.1% base rate. So clearly inflation and the consequential uptick in interest rates has an effect on property. I think the economy is showing relatively low growth, but against very full employment, and those employment numbers are translating into higher wage structures, wage increase. Quarterly numbers are showing up at about 3.6, 3.7%. So it's an unusual environment where you've got relatively full employment, you've got relatively strong wage inflation coming through the system, you've got sticky inflation at 6%, albeit it's expected to taper off in the next couple of years, and a higher interest rate environment. And I think when you take those macros together with the fact that you've also got now geopolitical uncertainty as well, there's a lot for real estate investors to really carefully think through in this environment. We're really optimistic on construction financing, and I think outside of the banks, we're most probably one of the largest alternative construction financiers in Australia. And the reason we're really positive on it is that our major focus is on residential property, and we see that sector of the market exceedingly strong. So notwithstanding the macros that I've just been through, which one has to have very strong regard for, residential property has less than 1% vacancy rates. You've got significant population growth and immigration, which we've talked a lot about, and it takes time to put product into the market. So by the time you actually decide, I would like to do a development, to the time somebody's actually occupying a building, it could be 3 years, it could be 4 years from that moment of time. So the market has been caught very short, and I think that what's happened previously is construction costs increased through the COVID period with supply side issues. In particular, it took a while for recalibration, particularly around realisation values, to come into the market. But we do see a lot of green shoots for now the next cycle of the market, and hence why we're receiving a lot of capital commitments for Australian residential construction at this point of time. Well, sticking on construction first, to answer that part of the question, I feel, and I hope that this won't come to bite me, this next comment, but I feel we're most probably through the worst of the large commercial builders having some form of insolvency type event. Now, that doesn't mean there's no one else out there that is continuing to struggle, but I think the most significant issues are most probably behind us, and I'll carve out of that the smaller non-commercial builders and the volume home builders, because I think that's a totally different conversation. But on the large end of heavy construction companies, I think their balance sheets are in relatively good shape. I do think that we're very carefully monitoring the sub-trades, the subcontractors, because there's counterparty risk between the head contractors and the subcontractors. A lot of the more experienced builders are actually having, they're forward ordering their raw materials, they're keeping those off-site, so ensuring they've got adequate working capital to meet construction commitments is a really important part of our analysis and focus. So they're the types of things that we're very focused on in construction. I think more broadly to your question, for us it's really about supply and demand of the specific property, location, can never go past that, consumer demand, occupier demand, capital structure that is being proposed. They're the various areas that we're really having a lot of regard to. Maybe the most important aspect from a property point of view is what is the underlying cash flow of the property. And It is true that a lot of the money is made in the buying of and the acquisition of the property. There's no doubt about that. But in terms of the longer term, medium to longer term outlook, it's about the cash flow sustainability and the ability to escalate your cash flows from the date you actually purchased it. And I think some sectors of the market can more easily achieve escalation. So an example of that is residential property. You know that you've got very tight supply in the market. You know you've got exceptionally strong demand. You're seeing rentals escalate depending on where you are by as much as 10% in various major cities. So you're getting fantastic growth in the underlying asset class. Now there might be others where you're not getting that. So office is an example where you've got work from home, you've got excess supply in the market, you've got vacancies generally running at 15% of the market, you've got leases that are coming up that you can't renew at the same rates as what you previously had. So you've got flattening, maybe lowering cash flows, higher interest rate environment, and you would have to be more cautious about that particular sector. As a lender, we would have to be more cautious about that particular sector of the market at the moment. So they're the things, we think very deeply about.